The European Central Bank cut rates for the second time this year, but gave no hint at all regarding the pace of future rate cuts. Then the US producer prices came in slightly stronger than expected on a monthly basis, but didn't have any impact on Fed expectations. Then the Fed is expected to start cutting its interest rates next week, so the US dollar softens, the US yields fall, and gold trades at an all-time high level. So welcome. This is Swissquote Daily Market Talk. So the European Central Bank yesterday lowered its deposit facility rate by 25 basis points for the second time this year, and its other two raised by 60 basis points. But that was just a technical twist that actually meant to narrow the spread between the deposit facility and the main refinancing rates from 50 to 15 basis points. So don't be confused. It was not an additional easing and didn't see any sharp reaction from the market. So yes, the European Central Bank cut yesterday for the second time, but its head, Christine Lagarde, kept a poker face really for what's next. She actually gave no hint whatsoever regarding what the European Central Bank is feeling like doing next. So she said that there is no commitment to a particular rate path. And the updated forecast from the ECB didn't help much either, because the European officials revised their growth projections lower for the next 2 years, and they kept their inflation forecast unchanged. But they increased their core inflation forecast for this year and for next year. It was like, tightening the belt on one side, but loosening it on the other side. So this is how the European Central Bank decision came and went yesterday, leaving a lot of unanswered questions behind. It is now widely believed that the European Central Bank will refrain from cutting its interest rates again in its October meeting, and that probability fell from 40 to 20% after yesterday's decision and pressure. So the 10-year German bond yield rebounded from its August low levels, and the euro gained strength across the board on hint that the European Central Bank will do less to save the economy of the Eurozone and more to make sure that prices are stable than the Federal Reserve. So the euro dollar rebounded yesterday from the 110 psychological level and is trading at 110.86 at the time of talking. The euro pound, on the other hand, is not reacting much to the news, as the Bank of England hawks remain in charge of the market right now, and that despite the deteriorating optimism regarding the UK growth after the latest economic data came in. In equities, the European Central Bank decision resonated quite well across the STOXX 600 index. The index gained 0.80% at yesterday's trading session, but the news flow wasn't enchanting, mind you. After bad news from Volkswagen, which announced the first closure of production plants of its history in Germany earlier this month, it was Stellantis' time to announce that they will suspend the production of the electric Fiat 500 in Italy due to a lack of orders in Europe. So the shares fell, and because we are just talking about the gloomy European growth outlook, and because Christine Lagarde also referred to it yesterday, you certainly heard that the ex-European Central Bank chief Mario Draghi, came up this week with an almost 400-page proposal across the European Union targeting key sectors such as defense, digitalization, and clean energy. So yes, Draghi wants the Europeans to invest massively in these three sectors and finance this massive core investment by issuing joint bonds. So the plan aims to make Europe more competitive and less dependent on external resources, make it better compete with giants like the US and China, while creating an EU-wide treasury bond to help finance these initiatives. It is an excellent initiative, really. It would not only give Europe, the old Europe, a bigger posture in the global platform, But it could also help the old continent get up to date. Because when you compare Europe to the other parts of the world, like US and China, innovation in Europe remains quite mega. And relying on luxury brands is obviously funny, but we can certainly do better. But there's always a but. Well, Draghi's plan demands a lot, but a lot of political effort within the EU that the countries like Germany and France, for example, the wealthiest ones, but that are sliding toward the right, will not be ready to make. But I have been asked about what I thought about all this and about the possible effects on inflation of this huge plan. And to be true with you, such a big co-investment could actually and indeed boost inflation and pressure the yields to the upside in the short run. But faster, healthier, and sustainable growth and improved productivity are actually the best known remedies for inflation in the medium to long run. Now, I would be surprised if the EU gave a green light to Mr. Draghi's proposal, but if it does, well, it would be a joy for long-term investors in Europe. Voila, this is what I think. I think that is a great idea, but it's going to be difficult to put in place. Now, in the US, market move was very well at yesterday's trading session. We saw a slight uptick in producer price index in August, but on a monthly basis, a bit like Wednesday's CPI data, but the yearly PPI rose less than expected by analysts. So that was good news. As a result, the US 2-year yield remains under a decent downside pressure right now. The US dollar remains sold as well across the board, and equities continue to recover. The S&P 500, Nasdaq, Dow Jones, and the Russell 2000 index, well, they all extended gains yesterday. Nvidia gained nearly 2% on news that OpenAI is now preparing the release of Strawberry, which is a new AI model that's designed to handle advanced problem-solving tasks better by focusing on step-by-step and human-like reasoning, which actually enhances the quality of its responses, especially for difficult queries. This is how ChatGPT describes the new Strawberry. And that, combined with NVIDIA CEO Jensen Huang's complaints earlier this week about too strong demand for his chips, while the AI fatigue that we've been seeing since weeks now seems to have eased this week. And in the sense, VanEck Semiconductor ETF held ground at the 200-day moving average this week, and its MACD, which indicates the short-term trend, is just about to turn positive. Elsewhere, gold rallied to a fresh all-time high level on falling yields and softening US dollar, while crude oil tested the $70 per barrel resistance for the US crude I'm talking, and that despite unsupportive news from the IEA. Because the agency said yesterday that global demand growth is slowing sharply, that the world consumption increased by 800,000 barrels per day in the first half of this year, and that's a third of the expansion that we saw in the same period last year. And its head, Fatih Birol, said that the Chinese economic growth is slowing down. Yes, it is. And the penetration of the transportation system by electric cars is also going at a very strong pace. And IMF also stated the obvious yesterday. It said that China's stimulus measures have only modest effects on exports, and imbalances are mostly driven by macroeconomic fundamentals in the country. Nothing that we didn't know. So yesterday's rebound in oil prices was certainly refreshing, yes, but the rising demand concerns across the globe will likely limit the top side in oil prices. As such, we expect top sellers to remain in charge of the market within the $70 to $70 per barrel range. So this is all for this week, guys. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.